Hey everyone, I'm Michael Zajko,
I'm Regan Bozman.
and welcome to the first episode of the Token Warrant, our new podcast. Exciting times, Regan. Why are we starting yet another crypto podcast?
It's a good question. I think we felt like talking to founders and investors after a round got done and understanding the perspective of each of those participants in the round, understanding why an investor was excited about a specific investment, how that investment came together. We felt like it was an interesting side of the business that just wasn't covered by any kind of existing podcast or news outlet. And so that's why I wanted to start this and really kind of try to just tell those stories. And, hopefully they're both interesting to other founders kind of thinking about potential fundraisers down the line, or just people excited about those projects and wanting to understand more why their investors backed them.
Yeah, I think that's a great reason. And another really cool aspect of it is that we can go back in time. So imagine going back and being able to talk to the original lead investor in Solana or some other high profile projects and understanding if the thesis that they had at that time really played out. So I think it should be pretty fun to not only hear these episodes in real time, but also go back in time and a year or two from now and see, what investments played out and if they played out in the way those investors thought they would. So we've got our first episode this week. We're going to be talking to Josh from Parafi and Brandon Kumar from Layer3. This is a good one for us because Layer3 is an existing portfolio company of Lattice. So it'd be cool to hear from them, but Parafi is the lead investor on their latest Series A round, which we'll be hearing more about. But maybe Regan, if you can give a quick snapshot of a preview of what listeners should be expected to hear.
Yeah, I think Layer3 is one of the most exciting businesses in crypto just because of the scale it operates at. So for people who aren't familiar, it's basically become like the largest discovery platform in crypto. So almost kind of think of it as like the front page of crypto where new users are coming and seeing what new products they can try, what new features that products they've already used have on offer. And they've scaled this business to well over 500,000 monthly active users. And their customers include basically like every large L2 and a lot of the leading applications in crypto today. So I think just having a company on that we've both been fortunate to work with for more than the last 2 years, but also that, anyone listening could go try out the product and kind of like deeply understand. I think it was a really cool episode to do for the first one.
Yeah, I think some of the highlights in this episode for me, number one is how Josh actually met Brandon, which was at first being an intern for Brandon many years ago at the investment firm Accolade. How Parafi has been involved since day one with the Layer3 team, and some of Josh's theories around aggregation theory specifically and how it applies to Layer3. So without further ado, this is the first episode of the Token Warrant. So we'll stop the preview and we'll let you listen now. So have fun, everyone. Hey everyone, I'm Mike Zajko. I'm a co-founder of Lattice and also co-founder of this podcast, The Token Warrant, a new podcast that you all are listening to right now. And I've got our resident podcast expert, Regan Bozman, as one of the other co-hosts here. And then we'll introduce the other guests. But Regan, why don't you introduce yourself?
My name is Regan Bozman. I'm one of the co-founders at Lattice alongside Mike.
Awesome. So the purpose of the Token Warrant, the podcast, is to talk about the latest deals in crypto. But you're not just hearing from Regan and myself, you're hearing from the actual founder and investor that worked on the deal. In this case, we've got two new guests that we'd like to introduce and tell you a little bit about themselves, and then we'll get into the meat of the conversation.
Sure, I can
Brandon, you want to kick things off?
Yeah, happy to. I'm Brandon Kumar. I'm one of the co-founders of Layer3. I'm sure we'll be talking a lot about what we're building today. But before starting Layer3, I spent 6 years on the investment side at a firm called Accolade Partners, which is one of the larger alternative asset managers in the venture industry at large, and more recently, one of the larger LPs across the crypto landscape, which is where Josh and I first met each other. We worked together on the investment side, and also where I met Regan and Mike.
Awesome.
Hey, Josh on the Parafi team. I focus on investments, been at the firm for around 2.5 years. I have the pleasure of working with founders like Brandon. Focus on early and late stage.
Well, thank you both for joining us. So the purpose of the conversation today is really to talk about the latest fundraise that Layer is announcing or getting ready to announce. Hasn't announced it yet, but you all are watching this live, or not live, the recorded version. So Brandon, maybe you could give us a little insight into the fundraise, and then we can go from there.
Yeah, and thank you guys again for doing this. But I think to level set for the audience, Layer, if you're not familiar with it, we refer to what we're building as a decentralized distribution network. So it's a two-sided marketplace. On one side of the marketplace, you have Layer 1s, Layer 2s, dApps, and we work with them to help them reach, acquire, retain, and engage the right users on-chain. And then on the other side of the marketplace, you have consumers, and we offer a discovery mechanism where consumers, through our interface and other distribution channels, can find protocols that are relevant to their needs and interests, but also earn ownership in those protocols. And so the context of this conversation is obviously around our Series A, which we just announced. It's $15 million financing, co-led by two great firms, one of which is an existing investor, Parafi, and Josh was the deal lead there. And then the second is a firm out of Berlin called Greenfield One. So we're super excited about the Series A. I think it's a testament to a lot of the effort that the team has been putting in over the past two and a half years. And we'll chat a lot about our traction and kind of why we pulled the financing together. But hopefully that gives a nice overview on the round.
Yeah, and since this is one of the first episodes, just to set some context for those of you who may be listening, at Lattice, one of the things that we always try to do is think about founders and what they're interested in. And we've gotten a lot of questions from founders on how did certain deals come together. So they'd say, oh, so-and-so invested in this round, in this case, Parafi investing in Layer. And they kind of wanting to get kind of the backstory and the context. So all these podcasts are really to get into the backstory of how a deal came together, how a investor might have been thinking about it, how they diligenced it. And Josh, who's joining from Parafi, is really going to chime in there and walk us through that journey, and then Brandon can tell about their experience during the process as well. So yeah, maybe Josh, give a bit of background on how you got started and how you got to know Brandon, because it sounded like you guys have a longer backstory than just the investment.
Yeah, I'll start us off a little, and then Brandon, I know you have a lot to say here too. It's been a pleasure to know Brandon for over 5 years now. So I knew him in a personal capacity before I joined Parafi, before he started. And it was nice because I actually got to see him embark on his founder journey since day one, and maybe even, day negative, whatever, where he was thinking like, hey, is this what I should really be doing? I think he, of course, made the right choice and has just grown so much ever since. When I joined Parafi roughly 2.5 years ago, I then got to work with him from the investor side. So it's been, hours and hours of calls, in-person strategy sessions, debriefs, just a lot of quality time with Brandon. Brandon, I'll let you kind of maybe kick it off with how you started your relationship with Parafi, because I wasn't there right at the start. But yeah, it's been a great 5 and so years.
And maybe just to interject there real quick, Josh, you had mentioned, I think were you an intern at Accolade before joining Parafi?
Yeah, so that's how I started back then. And Brandon was the first person I met at the firm. He actually interviewed me. So we've swapped roles a couple of times in that regard. And it's kind of just been great building that relationship over time. Yeah.
And for those of you who don't know, Accolade's a very prominent fund of funds in the space. They've been, really one of the pioneers in investing in crypto funds. And there's now, it sounds like a mafia of ex-Accolade people. It's you two, Will over at Faction. I'm sure there's a few others that have made migrations to various places on the founder investor side in the industry.
Yeah, there's an investor over at Variant as well. So fortunately, Accolade has done a good job, I think, of graduating alum in the crypto industry. I think it's this podcast in many respects is connecting many different dots, because I joined Accolade actually as an intern in 2014, graduated in 2016, and then was a generalist. So I was doing venture growth, buyout, tech, and healthcare, kind of the whole gamut. And we were one of the larger investors in Andreessen Horowitz. And when Andreessen came to market with their first crypto fund, that earmarked the firm's entrance into the category. I was able to, along with the other investors at the firm, spend a bunch of time meeting people in that era. So that's like 2018, 2019. I remember having breakfast with Jesse before he started Variant, or when he was starting Variant. We spent time with Olaf at Polychain. Obviously got to know you guys. And funny enough, the first investment memo that I wrote when I was at Acolyte in crypto was Parafi. And so I had kind of the fortunate seat. And I think it's an unfair advantage as a founder to have come from the LP world, because you have met hundreds of different investors, different profiles, and you've also understood how to go about referencing those folks. And so when I was in that LPC, this was when Parafi, I think, was maybe 1-2 years into their journey. And we did 20 references with all the different founders that Ben had worked with at the time. It was very clear that the combination of his background at KKR and then his conviction in crypto positioned him to be a very good partner for our first round. So when I ultimately made the decision to leave Acolyte, and again, Josh was there, so that was a really instrumental time. And start Layer3, Daria and I, my co-founder, were introduced to Ben under that context, and Ben was one of the first calls that we had. He was also the first term sheet in the seed round. And I think we'll talk about this a little bit in today's conversation, but Parafi, along with Lattice, actually invested in the seed round, our seed extension, and then again in the Series A. And one of the beliefs that I have as a founder is the more alignment that you can find with the GPs that you're working with, or the firms that you're working with, the better. And there's two key things that matter. One is time. So in the same way that a hire might take 3 to 6 weeks or 3 to 6 months to become really productive, I think that a good investment relationship takes over a year. And then the second thing is check size relative to fund size. So again, this conversation is meant to discuss like the construction of a round and founder psychology and investor psychology. I think if you can find an opportunity where an investor's check size in your business is significant relative to their fund size, that's maximum alignment, because that means your success leads to their success. Incentives are aligned. They're spending time on weekends helping you. They're spending time, as Josh mentioned, doing these whiteboarding sessions and really thinking about the business. And so when Parafi expressed interest in this round, and I think Josh probably has the best perspective on the thesis at the Series A, it was a no-brainer for us because it was an opportunity for us to only get more alignment with them.
That's awesome. I mean, what a great seat to be in to eventually go out and become a founder. You basically knew all the investors out of the gate, and maybe they owed you a few favors after Accolade invested in them. But that's I didn't even know all that background, so it's cool to hear it. So Josh, when you came into Parafi, like how did you get put onto the deal? How did was it like, hey, I already know Brandon, I want to work with him again? Like what was the context there?
Yeah, I think Ben was aware of that relationship. Maybe it was also just a bit of luck. I mean, Brandon is just a great founder to work with. So I got onto working with Layer3 really, really early since joining, and it's been one great journey ever since. I mean, we can get later into how Brandon and I work together. It's a very interactive relationship with a lot more than just a regular catch-up call. But basically, yeah, I think it's been now roughly over 2 years working with Brandon in that capacity through the follow-on. So I was part of that discussion, and then kind of critically for this round, we're very involved there, and I can kind of walk through if you want, what that diligence process was like, because it's different than your typical Series A, and I can explain why. But yeah, that kind of summarizes our last 2 years in a bit.
Yeah, I think understanding the diligence process thesis around this investment, what you guys got you guys excited to double down here.
Yeah, no. So at Parafi, kind of taking a step back, we strive to be very meticulous and thoughtful about the investments we make. Our process is very focused on fundamentally understanding the business, and then the people leading this business. So if we're going to be long-term partners, we really need to have this fundamental understanding, and kind of that leads to questions like, how does the company fit in the world we see evolving over the next few years? How does it accrue value? Why does it accrue value? And then importantly, can it keep doing so for the ensuing years? Like trying to tease out that defensibility. Are the founders the right people? Is their founder market fit? What is their character like? or can they lead people into like the darkness of the night, right? Because a lot of times things go wrong in startups, and you really need someone that can guide people and make them feel that, hey, you're not making the wrong decision. Like, just let's go through this pain together, and we'll get to some pot of gold at the end. So we try to really go deep into the DNA of the business and of the founder, and how do we accomplish this from a process standpoint? I think the table stakes are several calls with founders. We try to meet them in person. This just allows us to build depth on the business, who they are. We then do our own reference calls, kind of alluding to what Brandon would do at Accolade. Ideally, it's references where our network can kind of allow us to get a view on them without being, introduced to their best friend to give a reference. But of course, we take those introductions because every point is valuable. We look at a lot of data. I think we're privileged to be in an industry where there's just a wealth of on-chain data that you can kind of cut and look into, and to determine whether it's traction, whether it's what type of usage is an application exhibiting. Deep financial modeling, especially for growth companies. So we've built out your standard DCFs, unit economics analyses, etc. And then the favorite part is the intense IC discussions, where all these materials are kind of put together. Everyone pre-reads them for a period of 24 to 48 hours, and then we kind of go into a robust discussion or two or three on the company. So that's a little bit about the process. What I will say is it was a privilege in the sense with Layer 3, because our diligence period was 2 to 3 years, right? And I use the word privilege because a lot of times on the investor side, you get into a process and you have a matter of weeks to kind of get to know someone who you're going to be partnering with for a long time. In the case of Brandon and Daria, we had years to build up a lot of this intel, this data, this knowledge on them as people and their company, which could then allow us to move in a little more of a streamlined fashion in the case of this round. So I think it was a couple of months ago, Brandon and I started to discuss what the next phase is for Layer 3, and we both sensed the opportunity and the need for a financing round. And from there, it was a more streamlined investment process where I prepared materials. We walked through it as a team, a couple of follow-ups and specific data deep dives, related to cubes and a couple other elements of the business. But it led to us issuing a term sheet, and things progressed from there.
Yeah, Josh, one of the questions I have is, Parafi, you guys are in everything from seed stage, Series A, and beyond. It's just how common this is for you guys, like to work with a founder from such an early stage, basically idea through Series A, and then in that journey, what your expectations are. Because I think what's cool about Layer 3 is, whereas a lot of portfolio companies of ours, like, they go a bit of on a journey. If they're started seed, maybe they change their idea several times. Whereas Brandon and Daria have really executed on the original vision. I mean, they've added to it, but it stayed true. So if you go back to your old memo, is it basically pretty consistent with the memo today, or has anything evolved in kind of how you guys think about the space?
Those are great questions. I think there has been. I would say both. I think Brandon and Daria centered on a mission that still holds true today, but the business has evolved, and we can kind of walk through the step-by-step evolution in a way that just kind of went beyond initial expectations. I think the way Brandon has positioned the business today is, my personal belief is much stronger than where it started, and that evolution and those kind of pain points that him and Daria went through, I think, informed that. That being said, there are other cases where we've had really strong pivots. I don't think this is one of them. So it was a combination of both. I think our memos would decently line up. Founder quality was a big element of both investments. We're again privileged to have a lot more data the third time around with this specific round. But I think even back then, in terms of the original investment, the impression that Brandon and Daria gave was really positive. And as you guys know, since you're pretty prolific investors in the early stage, execution is a super majority of that return potential. So that was great. I will make one general observation, is one of the true holy grails of venture investing, in my opinion, is being able to kind of be that preemptive investor with information asymmetry. So where we've had these opportunities in our portfolio to double down on founders that just have an exceptional execution capability, where we have the data, we have the conviction, and this being the right time to take that step. It's great because, we can act earlier than other investors. We save the founders a lot of time, and then we can really just put more capital and double down in a phenomenal business. And that is part of the reason why at Parafi we take portfolio support and founder relationships very seriously. Of course, we want to drive value for them first and foremost, but it does allow us to create these opportunities to double down.
Yeah. One thing just to piggyback on Josh's point, a little bit, Mike, to your question around the breadth of Parafi's portfolio is culturally, Layer 3 from day one has been extremely metrics oriented. So in the morning, we kind of do a daily stand-up. Everyone reports what they're supposed to do for the day. On the non-technical side, everyone has a metric that they're measuring themselves against. And a lot of people will say, okay, maybe you shouldn't measure that on a daily basis. And we've gotten, I think, smart at understanding what it's okay to tolerate if it's moving against us in a shorter period of time to optimize for a longer period of time. But the reason that I bring this up is Parafi has such breadth of their portfolio that it's very easy for me to go to Josh or go to Ben and ask how metrics are trending across the portfolio on a specific vintage. So we can say for 2021 businesses, how are they trending well in the current market? Are they trending down? How do their revenue numbers look? How do their user numbers look? And I think Josh has led the effort on making sure that is systemic across the whole portfolio. And there's like a phrase that I heard recently that I think is true for both Parafi on underwriting this deal and then us getting value out of Parafi, which is teams perform based on what you inspect, not what you expect. And so we're able to get a good pulse on like the data, and then we can relay that back to the team, which is, okay, it's a sideways market, but these categories are still growing. And I find that really helpful from the founder side.
Yeah, I mean, for those of you who are listening that might have got lost in all of that, because there's a bunch of terms in here that maybe not everyone knows, but in terms of preempting, that's probably important to define. So maybe Josh, you can kind of talk about like preempting, and then maybe we can like hear from Brandon on like your decisioning on like, hey, let's agree to this versus let's go put ourselves out there for everyone to take a look at. But yeah, maybe Josh, you can talk a little about the preempting process.
Yeah, no, for sure. I think, probably most venture deals investors will find themselves participating in. They kind of get to when there's already, some structure, some numbers in the mix. There's other people involved. And why this is tough is just factually there's more variables outside of your control. You're on a clock with like your diligence timeline. There's just a lot more at play. Whereas with Layer 3, we had these 2 to 3 years where we did our diligence and we could kind of kick that process off ourselves. And we came to a set of terms that was mutually agreeable and a win-win for both sides. So I wouldn't say it's preemptive in any negative sense. It's just nice to be able to set kind of the parameters, to understand what Brandon and Daria wanted, to meet them there, and then basically kind of create a process that could be a little more streamlined and one that we could have a greater say in. So it could formulate around that both Brandon and Daria and us were excited about, in terms of introducing new partners, in terms of getting some of the folks that were already there even more invested. So I think it's controlling those variables that is pretty valuable.
Yeah, and Mike, to your question around, I guess, how we thought about accepting the preemptive term sheet versus doing a broader process. What I've more or less learned as a founder is that time is like the most precious commodity you have. And so when you go out to start a business, your seed round, your only job is to fundraise, right? At that point, you don't really have a product, you don't have a team, you don't have people demanding your time. You probably don't have customers either. But by the time you get to Series A, particularly for the business that we have hundreds of customers, we have hundreds of thousands of users, we have a larger team, and you have execution that needs to happen on a day-to-day basis. And running a fundraise takes a tremendous amount of time. So first and foremost, if you can accelerate that, you should. The second is, if the terms are aligned and you're happy with where you're netting out with, I guess, whoever's giving you the preemptive, it makes more sense practically because, to Josh's point, they understand the business. So it's not a cold start. It's not 6 months to understand how to work with you, build a relationship, provide value. It's just it's basically further aligning incentives and then continuing to grow that relationship. So that was how we thought about it. But it was important to us that we want the existing investors to double down if they're excited about it. And again, we're fortunate, I think. Lattice invested out of Fund 1 and Fund 2, so we're excited to work with you guys even more after this round. And then it was the same thing with Parafi, Electric, doubled down in all 3 rounds. So that's, I think, a testament to our execution. But then we wanted to complement that with investors that brought in different expertise. So in our first 2 financings, we had capital that was primarily based in the US. Crypto is global. Our networks are, I think, very strong in the US, but we need to strengthen them in Europe and in Asia. And so we went out and found a co-lead that's based in Europe. We brought in follow-on investors that are based in Asia. And a big part of us expanding over the next several years is really understanding those regions. So it was a perfect opportunity to strengthen the alignment with the existing cap table and also bring in a strategic group of folks on the syndicate.
I guess moving on from the process, like, would love to just hear Josh, like, let's hear the thesis. Like, pretend I'm Ben. I'm in a quarter zip fleece, sitting in a Westport conference room. Like, why do you want us to invest in Layer 3 again?
Yeah, no, I'll start high level. Maybe hit at 3 critical points, and then we can deep dive where you and Brandon see fit.
Yeah. I think also just, like, to provide context, like, to make sure everyone, maybe like high level business overview, just to like start with that, and then kind of like the
So that'll be point 1. I'll explain how I understand the business, which I think is critical to underwriting its long term success. So what is Layer 3? I mean, Brandon started with the kind of commercial overview. I'm going to say it's an aggregator. So Brandon and I are both enthralled by aggregation theory, which was coined by Ben Thompson, so he's author of Stratechery, a really good kind of tech strategy blog. So if you study the most successful businesses, internet companies of the 2000s, a lot of them were aggregators. They kind of came into these large markets. They modularized one end of the 2-sided marketplace or the ecosystem, and then formed this direct, almost like ownership relationship with the end user. And I think a great example, and one that's relevant to Layer 3, is Facebook. Before Facebook, maybe we can like use newspapers as an example. You kind of had ads and content kind of integrated, packaged together. They came and disrupted this. Why could they do that? Because distribution is free in the internet. And then they essentially formed a very highly effective way of targeting users, which they ended up kind of creating this pseudo ownership. And we can get to like the negatives of that in the Web2 contest, pseudo ownership relationship with the user. And so aggregators have 3 characteristics: direct and strong relationship with the user, 0 marginal cost for serving an additional user, and then these kind of lowering acquisition costs over time for this demand side network. When there's like a little bit of a network effect there as well, but we can set that aside. I think Layer 3 is poised to be one of Web3's key aggregators. And why is Layer 3 an aggregator? Kind of getting down to what does Layer 3 do? It takes these protocols, which we can think of as the suppliers, it aggregates them, and through like the platform and now the protocol as a distribution mechanism, it brings them in a pretty slick and engaging way to users. And on the user side, it's also aggregating them. I think I've seen more and more people start their daily Web3 journey on Layer 3 and do a lot more through Layer 3. And so what Brandon and his team are doing is basically aggregating this demand side and forming a direct and strong relationship with the user. Now, why is that important? Because it informs the bargaining power, shout out to Porter's 5 Forces, that Layer 3 is able to cultivate on both the supply side and the demand side. And this essentially allows for it to not only create a lot of economic value for itself, but as Brandon can maybe touch on, like in the Web3 context, create value for the ecosystem as a whole. Because it's taking all these applications, these protocols, it's essentially routing them to the most active users, I believe the most active users in crypto. And through that, it's actually creating a lot of economic value. So I want to iterate, which I think was an important part of the investment discussion and a part of the round in general. Like Layer 3 is not just a Quest protocol. I think Quests are good, but Quest was like V1 of Layer 3. We then like moved a little more to identity, and now we're moving into this aggregator model. And that's very powerful because the defensibility characteristics are much stronger with aggregators than just a simple application. But it's important that Layer 3 started with quests because that's how they were able to build up both sides of this ecosystem. So it shouldn't be missed that you couldn't just jump to where they are today. You had to have this evolution, and that model really excites us. I can go into the team and the market opportunity as well. Those are my points 2 and 3. But Brandon, I don't know if you wanted to add anything specific there, or either of you guys.
Yeah, I do want to just piggyback on aggregation theory. So this is like probably the best model to understand why it's such a powerful business. Because on the supply side, today you have, I don't know the exact number, but you have about 100 different layer 1 and layer 2 ecosystems that have emerged. You have the market today, top 20 projects have about $24 billion in native assets that are sitting in their treasury. We've talked about this a lot, Regan and Mike and Josh, I know, obviously we've spoken about this, but we perceive tokens to be CAC. Like, I think, depending on who you speak to in the industry, tokens have a different perception. In large part, one of the key motives behind launching an asset like that is to bootstrap your community. And so the flywheel is as follows. Every time we onboard a new ecosystem into our basically infrastructure, they route value through layer 3 to reach the end consumer. And every time we do that, we're able to expand our distribution moat because more and more consumers come to layer 3 to explore those ecosystems, which then makes the sell to the incremental layer 1 or layer 2 that much easier. And so in a world where every month you have new multi-billion-dollar layer 1, layer 2 ecosystems, even dApps coming to market, all trying to find the most efficient distribution channel, once you've established a flywheel, once you've built the aggregator, it's extremely easy to go and scale that. And so we spent the past 2.5 years and like getting that flywheel off the ground was challenging. It was, I think, just a lot of hustling and chatting with different teams. But now that we've gotten to a point where we're doing real revenue, we have a very large distribution channel, it becomes extremely easy to scale it into what we believe is a very fast-growing market. So hopefully that provides a little bit of color.
Josh, that was an eloquent thesis. There's much more. We got to get you in to fill in for Regan sometimes. The way he broke it down to me, but no, it's definitely in line with the way we think about it. And one thing I've been thinking a lot about is like if you compare layer 3 to like this aggregation theory versus something like a Facebook or Instagram or really like any big Web 2 property. And most of those are about like extracting time in order to disintermediate with some ad unit, and then there's demand side from advertisers. Or in this case, it's more like you're extracting time, but that time has like direct value to the actual person, and that relationship between the protocol and the user is more intact versus just having an advertiser inserted in the middle. So there's something really cool there that like I think is only going to get bigger, as layer 3 grows, but definitely makes a lot of sense.
Yeah, I feel like it ties into this kind of like attention economy thesis that people have been like spreading now in the context of meme coins, but it's just like a more direct like monetization of your time and attention.
Yeah, exactly. I mean, I would say attention is like one of the, if not the most critical in-demand resources in crypto, full stop. And to your point, Mike, what's nice about what Brandon and his team have been able to do is maybe we should coin the term aggregation theory plus, where instead of being very like aggregators, as they become bigger and bigger, like evolve into extractive systems, at least historically with the internet businesses. But can we, with the primitives of blockchain and crypto, form an aggregator that actually gives back to both sides? And I think that's what Brandon and his team are on the journey to do.
And in a market that is also increasingly fragmented on the supply side, so for better or for worse, the industry has funded almost an infinite number of layer 1 and layer 2 ecosystems, and these things have hundreds of millions of dollars in direct cash on their balance sheets. Once they launch their token, they have billions of dollars in their treasuries. The business model behind layer 3 performs exceptionally well in a bull market, and it also performs exceptionally well in a bear market. So in some ways, it's counter-cyclical, because the last dollar that you're going to cut spend on is the dollar that is helping you drive growth. All these teams hope that they're going to put up good numbers in a sideways market or a down market. And like the stat that's hard to pinpoint is if you look at the aggregators in the 2000s, roughly 40 cents on every dollar in venture financing raised was spent through a Facebook or a Google, right? Because those teams, they raise this money, they then need to go out and they need to get growth. And I think that number is probably the same, if not higher, in crypto. Because, I mean, think about the next month, right? We have Eigen, Monad, Bera, Linea, ZK Sync. All of these teams are coming to market with tokens, and they need to somehow excite users. So where are they going to put that capital? Through the most efficient distribution channel.
Yeah, right now, like, actually, Brandon, we haven't really talked about this too much, but there are limited options for a Monad or a Berachain beyond like their own point system for them to advertise and acquire new users. So when you guys are like talking to these teams, what options are they evaluating as part of their growth strategy? Because there's a bunch that we can get into just on general point strategies, which is the latest meta, and like people kind of starting to reject it. So curious kind of like how you think of the landscape of growth for teams.
Yeah, I mean, if you look back in 2020, when the first airdrops came to market, it was a novel concept at the time to give a certain percentage of your token to your community as a way to bootstrap it. I think Uniswap was probably the most famous example. There may have been a few that tried before it. But if you look a few years later, the number of users that are still active on the Uniswap protocol that received the Uniswap airdrop and the number of users that are still holding it, both of those numbers are less than 10%. And you're spending thousands of dollars. So coming back to the CAC point, are airdrops efficient CAC? Unlikely. It's $1,000 to $5,000 on the higher end, and you're getting less than 10% retention. And so over the years, what has happened is people have experimented with iterations on the airdrop mechanism. So going from one big airdrop to seasonal airdrops, and now you have this meta around points. But where I believe the world is going, or where we believe the world is going, is you have these large treasuries, and maybe you have an upfront airdrop, albeit a little bit lower and smaller, and then you deploy the treasury through infrastructure that is enabling you to reach the right user at the right time that will retain over a longer period. And so our infrastructure allows you to come and say, okay, well, I want to reach a user that has done X number of things on chain, they have a certain wallet balance, and I want to reward them if they take an action on my protocol, and I want to reward them iteratively. And then I'm going to examine the results, and I'm going to continue to deploy those incentives. And so when teams come to market today, I think we haven't quite left this era where you're giving 10 to 15% to the community. I think they'll still do that, but then they're going to use the rest of it to iteratively deploy incentives to reach the right user at the right time. And to tie it back to the financing, one of the things we're really excited about is improving that targeting. So if you're building a perps protocol and you want to reach users who have a propensity to retain on perps protocols, you can do so. If you're building a layer 1 ecosystem or a layer 2 ecosystem and you're reaching users who have a propensity to mint NFTs, you can do so. And I think that is in the same way that, when you first spent on Facebook or Google ads in the early 2000s, it was extremely inefficient. You were advertising a product, maybe you're advertising like, basketball shoes to men between the age of 18 to 25, but somehow those ads would still be served to women over the age of 50. And then over time, it became much more efficient. And I think the same dynamic will exist in our industry.
Yeah, it's interesting how, like, if you look at, of the FANGs, several of them are in the advertising business or the growth business. Like, that's something you can't really escape. Like, if you expect systems to grow, people have to find, there has to be a discovery mechanism. And, the teams are able to enable that in some capacity, it's no surprise they're going to be, very large players, have the potential to be very large players.
And again, you have, I think the cool part is their value redistribution. So in the past, what would happen is you'd create this aggregation and then you become parasitic to both sides of the marketplace. Rents become higher or rates become higher. In crypto, you have this kind of unique opportunity to establish product market fit and then enter this era of decentralization where as you spend through a platform like Layer 3, you also earn ownership of the network. And as you, as a consumer, touch the distribution or you touch the interface, you also earn ownership. And that establishes a moat that we haven't seen in the past, but is extremely powerful.
Got it. Now, Brandon, you've had the opportunity to get to know Josh and the Parafi team and us at Lattice over the past couple of years. Maybe for the founders that are listening or will be listening, it'd be awesome to hear kind of how you think about going to your investors, leveraging them, how you like to work with the Parafi team, like what areas, if it's on the token design or on legal. Like there's a lot of different ways that investors tend to get involved, but if you split them up in buckets, or like everyone gets kind of the same treatment.
I think you definitely want to have different investors for different functions. Again, tying it back to, I guess, my prior role, there is a wide range in approaches that different firms take. You have on one side, like the services model, so very large firms, and they hire functional experts, product designers, people that help you with PR, people that help you with executive recruiting. And then on the other side of that spectrum, you have where I would put all the firms in this conversation. It's much more of a direct relationship with the founder. You're texting them on a regular basis. You understand the business. You're trying to help across all areas at once. Depending on who you are as a founder and where you are in the life cycle of your business, it depends what you're trying to optimize for. I personally have found much more success with the latter, where you build a direct relationship with these folks, and you do your best to articulate the business as you see it, and you get to a point where you no longer feel like you're pitching them on a monthly basis, right? So a lot of investors will schedule these monthly update calls. In the first few calls, you still feel like you're pitching because you want to position the business from strength. The quicker you can get to a relationship where you're exposing the vulnerabilities of the business, the better, because then they can lean in and start really helping. And I think that we've done that 100% with both Lattice and Parafi. And to keep it specific to Parafi for a second, Josh, because he saw the evolution from day one, and because Ben has been very close to the business, they are able to help exactly where we need them to help. Where I would say they've been most helpful is on scaling the B2B side. They have a very large portfolio, and every time Josh meets someone who is qualified to effectively use our infrastructure, I'm getting an introduction, and then we're pursuing those introductions like relentlessly, and many of them have led to 7- and 8-figure contracts. And I think similarly on the product strategy side, we'll spend a lot of time with Regan in our regular calls chatting about where the product is today, where we want to take it. I think Regan's perspective, having seen a lot of these models over the years, is also really helpful. And I think just developing that direct relationship is important. The final point is, I think, a bit of a softer point. I do think personality alignment matters. And what I mean by that is some investors are very focused on the creative side or maybe the ideology. Some investors are very focused on metrics and process. And where Josh and I find a lot of alignment is on the fact that we both are extremely metrics driven. We're very focused on the inputs. We're trying to understand how what we're doing is being measured and how we can change it. And so when we spend time talking about layer 3, a lot of the conversation tends to go there. And I think that, if you're a founder, understanding the personality of the GP that you're bringing into the cap table is important.
Yeah, I thought you were going to give a shout out to beers up in Lake Tahoe. That was going to make it into the mix in some way, but
this podcast is in some ways you guys rounding out the ultimate tech bro trifecta. You've got Regan with the KOLs. He's got 40 tweet threads. He's got the ski event in Tahoe, and then now you both have a podcast.
Well, this is charging downstairs.
Regan needed a sparring room, so I had to create this so that when he goes for the big gun shows out there, when he gets on Laura Shin someday, he'll be set up well. Yeah, Josh. I mean, maybe just to let you kind of chime in on to that point. I think a big question that comes up from founders oftentimes, we get Brandon talked about the B2B work that you guys have done, but what kind of value is Lattice gonna provide? And we haven't answered that question, but I'd be curious kind of how you answer that, and is the context with layer 3 a little bit different here, or is it how you like to help most of the portfolio companies and founders that you're working with?
It's an important question. We get asked it as well. I think my approach tends to be consistent with all the founders I work with, regardless of check size, and I think that's partly the culture that was created at Parafi. I also see this job as a craft, and so I have to kind of practice it to the best of my abilities at all times. But one point I want to add to Brandon, to what Brandon said, I think what's very underrated is just being there as a sounding board for a founder. Being able to answer a call on a Friday night and hear someone this is not specific to Brandon, but hear someone just vent for 30 minutes. Because I think what's tough especially with CEOs is amongst their team, they have to look strong. And you can't be that vulnerable with your team because you're taking them on this mission. There's a lot of pain involved. There's a lot of just unanswered questions. So you can't go and say, guys, I don't know what I'm doing. But if you have a really good relationship with your investor, it should be a safe space to have that conversation and to vent about problems and to really just get down to, understanding other opinions. Like, what can an investor do that's really good? I think provide context on what other founders have done before, on what other firms are doing in general, or just basic feedback on a strategic direction. I mean, some anecdotal points. Once Brandon and I had this great series of calls related to selling into a large L2. Like, how do you approach them? Who's the right decision maker? What are they thinking about personally? Because everyone has their own personal incentives and kind of views. How do we get to them? What sales collateral do we use? Like, what data do we present? A lot of fascinating topics related to kind of quote unquote making a sale. And it was really great to dive into that. And Brandon eventually won that contract, which is a good result. Another one is we spent several hours on a recent Saturday just locked in this room that had a whiteboard, and we were just going through the overall kind of evolution of the business, the strategy, what's next, how to deepen defensibility. And I think those productive sessions where both sides just feel very comfortable, throwing a bunch of things out there, assessing them, being candid in what's not working and why is valuable. I would think. I mean, Brandon, I would presume you second that. Is just valuable to the business. So in a weird way, it's not that complex to explain. It's just being a really good thought partner, which is sadly a little rarer than not, probably in typical venture. So yeah, I would say that's kind of the main principle.
Yeah, you're making me feel like I need to step my game up. I mean, this is real. This is real help.
Beers in Tahoe also work. Beers in Tahoe also work.
Yeah. Josh, you've mentioned vulnerability a few times. I feel like you've got Brene Brown up on the bookshelf there in the reading club between you and Brandon. So we're coming up on time here, but maybe Brand, huge congratulations to you on the Series A and to you, Josh, on landing it. Maybe if you want to talk about just what's coming up next, what we should expect, and then we'll close things out with where we can follow both of you.
Sure. Yeah. So we are super excited about the round, $15 million round that will enable us to really scale the team. So we spent the first 2.5 years establishing product market fit, getting the flywheel spinning, and now it's all about accelerating that. And we have a number of open roles that I'd love to chat with you. If you're an engineer or you're on the data science side, please do reach out. And then as for the roadmap, we want to keep most of it close to the chest. But when we think about this market, if it's a fixed market, we believe there's tremendous room for growth for us, because as this distribution channel continues to strengthen, more and more of these existing layer ones and layer twos will use the infrastructure to reach the right user at the right time. But as I've mentioned, the market's expanding. It's an incredible market. It's growing incredibly fast. And so a lot of what we're doing on the product side is to better service the B2B angle, which is helping them reach the right user, and then also better service the consumer, which means giving them different ways to interact with the layer 3 infrastructure. So those are some of the product bets that we have on the horizon. And as far as where to find us, check out layer3.xyz. If you haven't already, create a user profile and begin completing some of these events that we call quests. And we're on Twitter at layer3.xyz.
Awesome. And then you have a pretty good Twitter following, Brandon. Not as big as Regan, but
yeah, I gotta take some notes.
How do people find you on Twitter?
Yeah, I'm at Brandon M. Kumar.
All right, perfect. And then what about you, Josh? What's coming up? Summer plans,
we're grinding, trying to find the next Brandon. So that's on the docket, which is always nice. Yeah, I mean, we share Brandon's excitement. I think all four of us are just, not only impressed with what has been done to date, but we're hungry to now take this to the next level, to step up the stakes. And I think it's going to be really great, next series of months. Brandon, you got a lot on your plate, but I'm sure it's all going to go well. And I mean, yeah, I think our job is to just try and make this a success. Same with other portfolio companies, and hopefully we can look back on our careers and say that we, as investors, did create real impact. I think that's probably the best outcome.
Awesome. Well, it's a good note to end on, creating impact. Josh, do people? How about following you on Twitter? What's the worst
by far
X, as they call it now?
I'm a long form writer and not good at
we're trying to help you out here. Whatever. Your email address.
Mine is at 0xjosh_. And I will be reading up on your guys' tweets for sure to try and improve my own.
You've got a few new followers now.
Absolutely.
After this. Well, thank you both for joining me and Regan. This was pretty special just because we're also big fans of Brandon, Daria, and the team. And thanks everyone for listening to the first episode.